Hi, I am Gustavo del Ángel, professor at Economic Department at CIDE. Now we have invited Professor Michael Bordo from Rutgers University. He's professor of financial history, one of the leading figures in the field of financial history, and director of the Center for Macroeconomic History in his university. Professor Bordo, very nice to have you here.
Thank you. Thank you for having me here. This is my second time to CIDE, and it's a great pleasure to be back. And it's a great pleasure to be in Mexico again. Every opportunity I get to come down here, I come because I like it so much.
So, Professor Bordo, the first question for interview will be, well, why is it important to understand the historical process in financial problems?
Okay, well, there are a lot of possible answers to that question, but mainly because finance developed out of history, and because many of the events that occur in the financial world are in many ways repeating or following up on things we know from the past. And my interest for many years has been in financial crises. And we've had many of them for centuries. And the patterns, there are these patterns that appear that seem quite similar across time and across space. And what happens is, whenever a financial crisis occurs, everybody says, oh my God, what are we going to do? Okay, but you know that there is an element of continuity. Okay, I mean, Reinhardt and Rogoff talk about this time is different, and their thesis is that it's not different. Now, I think there are differences each time. The story is different, but the fundamentals are often the same. So that's why I think that having a good understanding of historical processes, and especially in the financial sector, is crucial to try to learn from the past and not to make the big mistakes that they've done in the past. Of course, we never completely learn, but there's, to see if we can get some learning out of it.
So your conference today is about that, about how the recent financial crisis is similar to the Great Depression.
That's correct. What I wanted to, where this paper came from, and a number of other things I've been working on, is that when the financial crisis occurred in the United States and Western Europe in 2007 and 2008, there were some people that were saying, this is as bad as 1931, which was the worst year of the Great Depression. So my view was, well, I don't know about that's true, and it's because I don't think it's quite the same, but I think that there are some parallels. And so what my research has done is to see what are the parallels, what's similar about what happened in 2007 and 2008, and what happened in the Great Depression, and and what were the lessons that were learned by, for example, Ben Bernanke, the former chairman of the Federal Reserve. What were the lessons that he learned as a student from the Great Depression that he applied to what happened in 5 years ago? And then another element of my work is, and what was different about it? So maybe, even though I think he did learn a lot, there were some mistakes that they made, okay, in the way they handled the crisis, which have implications for the future.
Yeah, what type of mistakes, for instance?
Well, as I'll talk about later, so one of the things was that they originally, their first thinking was it was a liquidity crisis, entirely a liquidity crisis. And so they acted in the fall of 2007 by providing a lot of liquidity in a very general way. And for a while it seemed like it worked, okay. And at the end of 2007, things were quite calm. when they did this, they may have actually provided too much liquidity, which might have actually had some other problems, which led to them to worry about inflation. And then they followed too tight a policy in the first part of 2008. Okay, but the problem was not, liquidity was definitely a big part of it, okay? But it was not 100% of the deal. In fact, it wasn't even maybe even 50 or 60%. The problem was one of solvency, because you had these assets, these derivatives, that were being held on the balance sheets of many different financial institutions. The problem was it was hard to price the risk, because these were packaged mortgage-backed securities, and it was very hard to know what the real value of these securities that had been made from household mortgages, subprime mortgages, what they really were. And so what this did was it caused this uncertainty whereby people did not trust their counterparties. So banks that had been lending to each other in the interbank market were now very reluctant to do so. Okay, and so the Fed interpreted this as strictly a liquidity story, but it was a solvency story, because there were some financial institutions out there that if their assets were valued at the market, they would be underwater. And so solvency is a different issue than liquidity. Solvency, in a sense, is not really a central bank issue. It's a government issue, Minister of Finance issue. And you've got to get to the bottom of it. And so what happened was, the crisis happened, and then in 2008, they suddenly said, wait a minute, we're doing all these things. And they did a lot of good stuff. I mean, they did a lot of facilities they did to open up the interbank markets. Okay, but still the crisis didn't end. It was still going down, even after the Lehman Brothers and this huge injection of liquidity and cooperation between central banks. But the economy was still going down, and it didn't stop going down until they addressed the solvency issue with this program called TARP, where they recapitalized the banks and did the stress test. That ended it. Okay, so this, I think, was something that they were behind the curve on. Okay. Another problem, if you need to talk about it, was a moral hazard problem. So the way they dealt with an election, it's a two-part problem. One is there were these large banks, investment banks. What was the one before Lehman Brothers? That failed. Bear Stearns, yeah. So Bear Stearns was in big trouble, and they bailed it out. It was insolvent. They bailed it out because they were worried about counterparty risk and contagion. And then there was a lot of criticism of that, because people said this is going to lead to moral hazard. It's going to lead to these banks to take more risk than they should. So then they reversed course when Lehman got into trouble, and they let it fail. Okay, that led to a tremendous confusion in the markets. Then that was followed by AIG, which is not even a bank, and they bailed it out. And so now there's this flip-flopping, seesawing going on in the market. The markets are totally freaked out by this. Okay, that was a big mistake. They should have, in my view, and some people agree, but not everybody, they should have let Bear Stearns go, okay, and dealt with it then, because they created a worse problem by waiting from March until October. Okay, but then, in addition to that, the AIG thing opened up this really big problem, because they bailed out this large institution, which wasn't even a bank. The moral hazard implications of that were incredible, because now it meant that everybody is too big to fail. Anybody can be too big to fail. And that issue, in a sense, came out of the crisis. It still hasn't been resolved. Okay, they have legislation in the U.S., the Dodd-Frank bill, which was addressed to deal with this. But I'm quite concerned that when push comes to shove and something else happens, even if a bank has a living will and they've made all these arrangements to close it down, my view is that they will, if it's important, they'll save it. So these are the issues that I see.
So last question. What would you suggest to economists, to young economists, and to young historians to keep studying financial history? Because financial history covers many angles,
Yeah.
institutions, rule of law,
Yeah.
the decision of economic agents. So what would you suggest to
I find that, I mean, an approach to which I didn't take, because I've come from a macroeconomics, University of Chicago background, but the approach that, I find the approach that people at Stanford, like Abner Greif and Steve Haber, that focus on institutions, I think that's a very good way to go. And the other thing that I think has got a lot of future is sort of the microfinance side, coming at it from understanding how things work at a smaller level, but also being able to see it within the context of the bigger picture. So I think that people that work in corporate finance, okay, in behavioral finance, in those areas, those are the insights that are going to lead to the future, okay?
to the future of financial history?
Of the future of financial history. And those people who have these skills, the European guys working with Marc Flandreau in Europe, in Switzerland, they take this approach where they try to get in and understand. They go into the central bank, the Bank of England, and they understand the kind of decisions, micro decisions, that were made by the governors of the bank. And how did they decide how to do lender of last resort? Who did they lend the money to, you know? So that kind of research, which requires a lot of work, it doesn't require, you know, applying the macro tools, but it applies the hard work, archival tools, plus the understanding of financial economics. I think that's very promising, and I admire the young people that are moving in this direction. So that's what I would suggest. Yes.
Thank you very much, Professor Bordo.
Okay. Thank you.